Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to next week's big events from an economic perspective for the week starting Monday, the 29th of April. As we close out 1 month and begin the new, the themes are generally relatively similar, and that is the pushing back of expectations on when the Federal Reserve are going to cut interest rates, but also some question marks about what's going to happen elsewhere in the world as we see elevated monthly metrics and quarterly metrics for Australia, also raising concerns that we may have to be more patient elsewhere, not just in the US. In terms of some of the top line events to look out for, here's a sort of small overview of that. You can see on Tuesday or Monday night, we've got the PMIs coming out of China. Then we start to get into a whole host of data points from the Eurozone with the likes of German growth, Eurozone growth, the inflation rate. We've also got on Monday a number of inflation metrics coming out from specific countries within the Eurozone. Then later on in the week, really the second half of the week is dominated by the US with that focus on the jobs market, JOLTS job openings. We've got the FOMC meeting on Wednesday and rounding up the week with the US jobs report. And that's where we're going to start off. Here's an overview of the wider picture in terms of US economic data. Tuesday, we've got consumer confidence. Then we start that process of heading towards Friday's jobs report with the ADP non-farm payrolls release, the JOLTS job report, the initial jobless claims, and then crescendoing in that jobs report on Friday. And then, of course, on Wednesday, after the sort of back end of the session, certainly in the evening here in the UK, these times are all based in the UK. We've got the Federal Reserve interest rate decision. No change expected, but certainly the expectations around what the Federal Reserve are going to do continue to shift. Remember, the Federal Reserve were outlining 3 rate cuts this year at the last dot plot. Well, things have changed to the extent where markets are now only expecting 1 rate cut, and therefore it's going to be really interesting to see what the outlook is from the Federal Reserve. The past 2 months have seen pretty strong monthly inflation metrics, and that is something that we've seen across the board really in terms of the Western world. Doesn't necessarily fill us with confidence about this idea that we're suddenly going to embark on a huge raft of rate cuts, because we're not in that position. And certainly that does highlight the importance of the average hourly earnings number on Friday with the jobs report. Of course, everyone's looking out for that payrolls figure where we have just seen outperformance against expectations on a month-by-month basis. I think it's either 4 or 5 consecutive months now that we've beat expectations. The forecast is 190. I mean, if we beat it again and we get over 200K, it certainly wouldn't necessarily point towards any reasons for concern. The question mark only has been around where these really strong payrolls numbers have been coming from, and question marks about whether it's just down to people needing to take up a second job to deal with these elevated costs rather than new employment per se. But ultimately, unemployment rate remains low, payrolls remain high, and the question mark here is around the average hourly earnings. If we see the earnings number coming in strong once again, it does highlight those underlying inflation pressures that the Federal Reserve really needs to address before it can start cutting interest rates, especially because the economy remains strong. We did just see a weak GDP number coming out at the back end of the week just gone. So that might be something to note and to look out for when the Federal Reserve step up, because, of course, one side of it is their need to cut interest rates once inflation gets back down to target. The other side is that they might feel the need to do so if the economy starts to turn, but we haven't seen that quite yet. And so that weak GDP number will be particularly notable. We also saw a tick higher in terms of the core PCE inflation metrics. So once again, inflation not going away as things stand. And certainly I've been providing breakdowns on all of these different major releases and highlighting exactly that for many months now, that the US hasn't been in a position to head back down to target. And that's why we keep getting those expectations reshifted, rejigged as we moved throughout the year. In terms of the market to watch on this, I think an interesting market is to watch here is the S&P 500. Notably, we've seen this pullback coming into play as we saw this sort of breakdown through trendline support out of that near-term trend. Let's just get the top end and the bottom end sort of clipped on this sort of channeling pattern. Then that breakdown through support, through those swing lows, provided us with this significant pullback with that decline from top to bottom thus far, taking in a sort of 5.6% decline. Well, we have seen some strength heading in towards the weekend, but there's still some significant question marks around this market. And certainly if we see the FOMC push back those expectations further, that could hinder sentiment. And if we see a strong jobs report, once again, it would point towards this idea that, like, why would the Federal Reserve feel the need to cut interest rates anytime soon? That isn't likely to happen. You can see sort of on the top end, we have got the sort of, I'm trying to clip as many of these sort of top parts and try and give you the sort of general trajectory of this decline. That does highlight this area that has recently been respected. So will it be respected once again? Well, certainly if we see a breakup through this more recent swing high here, then that would start to build a bit of a strong strengthening narrative for the time being. And then you have that sort of wider picture and say, well, you know, could we be retracing part of this move if you see that as a single leg? So then we'll get the Fibonacci's drawn on as a result and see exactly where we stand from that perspective. So we're back down to that 50% mark. So possibility of downside, but you'd be looking at that sort of 48 to 4900 kind of zone as the really sort of deep end of that retracement. But like I said, if we break the 50.89 swing high that was established recently, that would give us a greater cause for optimism going forward. But I would be cautious because the Federal Reserve aren't necessarily in a position where they need to start coming out with particularly dovish comments per se, despite that GDP release. And so I wouldn't be surprised to see them push back on those expectations. But markets appear to have front run at this time. Remember earlier in the year, the Federal Reserve were pointing towards 3 rate cuts this year. The markets expected 7. Well, now the markets are expecting 1. And the last time that we heard, the Federal Reserve were expecting 3. So let's see exactly how those expectations get realigned over the week ahead. And then I wanted to talk about the Eurozone, and that's because we have a whole host of significant reports coming out, most notably the inflation report coming out on Tuesday for the Eurozone as a whole. But bear in mind, we're going to see little dribs and drabs of information that's going to inform us exactly where that inflation metric is going to come, and that therefore it does to some extent weaken the impact of the Eurozone inflation report when it comes out. Nonetheless, that's not necessarily a bad thing. It just means that we're going to see greater volatility over the course of Monday and Tuesday morning, because we see Spanish inflation, which is expected to tick low to 3.1%, German inflation, which is expected to rise to 2.3%, but they're only just above target anyway at 2.2%. Inflation rate in France expected to tick low to 2.2%, again, very close to that target. And the Eurozone as a whole, 2.4%. This is something that I have provided a preview to. And I think that ultimately Eurozone inflation really needs to hit target pretty much this time around, or else I don't think we're going to see it happen for some time yet, because from a base effects sort of narrative, the sort of year-on-year metrics that are going to be dropping out in the forthcoming months beyond this report make it a lot more difficult for us to see inflation heading back down to target in the near future. So let's see exactly how this plays out. Certainly, you know, when it comes to GDP data, which also comes out, a whole raft of GDP numbers on Tuesday, it's a question of, you know, do we see good news as good news or good news as bad news when you're looking at, say, currencies and markets? I would say that we're in a position where ultimately the ECB don't necessarily need further reasoning for them to say, oh, you know, the economy is weak and therefore we need to act. The economy has been weak. There's still significant struggles, in particular throughout the manufacturing sector. And so they will want to cut interest rates when they can. I don't think a stronger GDP figure is going to put them off that. And therefore, the idea of an economic recovery at the same time as cutting interest rates creates a strong narrative for people to be buying into equities in the European region. And that has been the case recently with many indices pushing onwards and upwards, even when US equities are moving towards the downside. Certainly, the week just gone has seen plenty of positive numbers coming out from the German economy. And so keep an eye out for this, in particular that German number, because like I said, some of these more recent figures do point towards the possibility that we have seen a bottom in the German economy, and we're going to see it strengthen from here on in. In terms of the market to watch, I wanted to bring up euro sterling, and the reason for that is essentially that we are looking at two currencies that essentially have high expectations for a June rate cut. And so the question mark here is, if we don't necessarily see that decline back down to target for the Eurozone inflation, would we see the possibility of markets suddenly shifting those expectations? Last time I checked, which was yesterday, the 25th of April, markets were expecting to see a 65% chance of a rate cut in June. I think that's overclubbing it, quite frankly, because with markets not expecting to see any change or any decline down to target, certainly at this report, I don't think that we're going to see inflation in the Eurozone at target by the time June rolls around. And I think, it could be a few months yet beyond that for them to do so. So it's a question mark of whether the ECB are happy to cut rates irrespective of being slightly higher than target. But certainly if we do see a strong report coming out this time, and it does highlight the fact that we might not necessarily see that rate cut coming into fruition in June, then there's a good chance that we see some strength for the euro, and euro sterling would make a lot of sense from that perspective, because people are continuing to expect the Bank of England to cut interest rates in the near future. Let me just get some of these Fibonacci levels drawn on just to show you exactly where we are at the moment. So essentially, I see this as a potential bottoming out area here. You can see it in the past that we've seen this sort of structure of support respected very well, sort of 0.85 essentially. So back in mid 2023, sort of Q3 time, you can see this area really forming strong support. And as we see here, it has been respected well recently. We've seen a protracted period of consolidation around this area, and then that pop higher in sort of mid-April coming into the week just gone. We've seen a decline this time around. But like I've shown you on that previous chart, there's a good chance that this decline provides us with another deep retracement. You can see the prior move gave us a 76.4 fib, and then we saw that leverage to push sharply towards the upside. Well, this time around, we're at the 61.8, which I've taken off, but that's where we are at the moment. So near term could see some downside, but as we approach that release, I think any stronger numbers in terms of those inflation metrics, I think there's a good chance that we do see this market bottom out and start to turn towards the upside if we start to see that happen. If you look at the trajectory in terms of this chart as things stand, we sort of topped out here. We saw flatlining highs. The neckline was broken. That essentially gave way with the breakdown through this first swing low of 86 essentially. And we've been trending lower since then. Certainly, if you're looking at the sort of downward trajectory, you can see we're now entering this sort of consolidation mode. You can see the possibility of that next decline down into the 76.4 fib taking hold at the moment. But certainly, I think there's a good chance that we do see the bulls coming back into play if the Eurozone inflation data were to come out relatively strong. It looks likely that, given some of the other numbers we're seeing for sort of German growth, I think there's a good chance that we see the Eurozone growth numbers looking relatively strong. So if Eurozone growth comes out strong and inflation doesn't get back down or close to target, and therefore points towards possibility that we might have to wait for a fair few months yet, as I've highlighted in my other video around that topic, I think there's a good chance for euro strength against the pound, and therefore look out for a potential break towards the upside. A break through this first sort of area of resistance, 858, would essentially confirm that bullish outlook. Until then, the near-term trend has been playing out towards the downside, but certainly you look outwards and you can see the possibility that we have bottomed out here for euro sterling, and this pullback at the moment could be advantageous for those that deem this to be another retracement before we push towards the upside for euro dollar. And then finally, the last area I wanted to focus on is the Canadian economy. Now, this comes off the back of an inflation metric that essentially pushed back expectations for the Canadian economy to come into essentially for them to start cutting interest rates over the near term. Let's look back at exactly what that inflation gauge was. So 0.6% on the monthly inflation metric last time around, with the core coming in at 0.5, whereas the previous was 0.1. So significant increases on both of those numbers. So will we see the Bank of Canada hold off, or will we see them essentially lay the groundwork for interest rate cuts over the near term? That will be really interesting, certainly given the fact that we're sort of playing it off against the US dollar as well. So if we see particularly some weakness in the economy, that could point towards the need for the Bank of Canada to cut interest rates before too long. Now, the forecast is that we will see declines on both of these metrics, both the sort of confirmation of the February reading and the preliminary March reading, both expected to decline, notably so for that March figure at 0.1%. But we're expecting to see that manufacturing reading up over 50 to move into expansion once again. On Friday, the expectation is that that will build towards a gain for the composite reading up to 47.5. So still in contraction territory nonetheless. In terms of the chart, I wanted to chart the likes of the US dollar against the Canadian dollar. And essentially what we're looking at here is a market that has been pulling back as we see some strength coming into play here for the Canadian dollar, in part because of this idea that actually those expectations for a June rate cut, maybe they're misaligned because of that latest inflation report. Well, if we start to see some weak data coming out of Canada, then maybe it comes back onto the cards and we could possibly see the US dollar start to strengthen once again. Bear in mind, it comes at the same week as we see the US jobs market under the spotlight, and we see the Federal Reserve coming out and likely sort of pushing back those prior expectations or pushing back their prior forecasts for rate cuts this year. So I think there's a good chance that we do see some strength coming off the back of that. I mean, ultimately, we're coming back down towards this trendline support. So 61.8 fib at 136.178 comes into play as we see the convergence with that ascending trendline. That looks like a particularly interesting one. But nonetheless, I think it's just an interesting one to follow on an intraday basis and see when we see that break. As things stand, we're continuing to trend towards the downside. Near-term swing high comes in the form of this level up here, which is 1373. Further downside does look a possibility, but coming off the back of a relatively strong core PCE number, I wouldn't necessarily be too surprised to see this market start to gain traction soon enough. Ultimately, from my mind, it's always been a case of having to keep realigning and pushing back those expectations for the Federal Reserve. That has happened to the extent that now markets are expecting December to be that first rate cut. There's a good chance it might not necessarily happen this year. Quite frankly, we've got to see how things shake out. But inflation pressures seem to have sort of resurfaced over the past couple of months. So near term, the downward trend does still continue. But look out for Fibonacci and trendline support as we come into these key metrics coming out of the Canadian economy, coming at the same time as the Federal Reserve and the non-farm payrolls and jobs report all start to come out. So should be a busy week for dollar CAD as it approaches this really key area of support within a trend that has been playing out very well thus far over the course of 2024.